Short exercise 5-3, journalize purchase transactions with a purchase return and shipping charge. So consider the following transactions for Tacoma Drugstore. We can view transactions here, or they pop up as you go along with the problem, so we don't need that open. So requirements are to journalize the purchase transactions. Explanations are not required. 2, in the final analysis, how much did the inventory cost Tacoma Drugstore? So we'll start out here with that first requirement, journalize the purchase transactions. Explanations, again, are not required. Assume the company uses a perpetual inventory system. Round the answers to the nearest whole dollar, record debits first, then credits, exclude explanations from journal entries. So on February 2nd, Tacoma Drugstore purchased $20,250 worth of inventory on account with credit terms of $315, net $30, FOB shipping point from Red Medical Supplies. So the credit terms here mean they're going to save 3% if they pay within 15 days of February 2nd. Otherwise, the net amount due is within 30 days. And what does FOB shipping point mean? Just as a reminder, FOB shipping point means the buyer pays shipping. So we're going to be doing the transactions for the buyer in this short exercise. Tacoma Drugstore purchased $20,250 worth of inventory. So let's talk about the inventory account. Remember, the inventory account is an asset account, therefore it increases on the left side with a debit. So do we have more or less inventory in this case? Well, we have more. So to increase inventory, we will debit it for $20,250. And because we're going to need to know the balance of inventory later, I'm going to also put it here in our merchandise inventory T account for $20,250. And you could be doing this here on a piece of scratch paper, and I'm just doing it in Excel because it's easier for you to read. And then there's no real way for me to do handwriting on these videos. So, all right, so did we pay cash for these inventory items, or did we buy them on account? It says we purchased them on account. That means AP is involved, and AP is a liability, so it increases with a credit here on the right side. So I'm also going to put that on our scratch paper here for $20,250, and then make sure we actually get it on the problem here. So it's account payable, Red Medical Supplies for $20,250. So let's go ahead and check our answer. Excellent. Okay. So next up, we have on February 4th, so 2 days later, Tacoma Drugstore paid a $90 freight charge. Why did Tacoma, that's us, why did we have to pay this freight? Well, it's because it is FOB shipping point, which means since we are the buyer that we pay the shipping. So let's start here with the easiest account to understand. We'll start with cash. So which way is cash going? Cash is going down, and since it is an asset, it will be going down on the credit side. So I'm going to lower cash, and I have to put it on the second line. Debits come first, and then credits second on here. So we have cash that we are reducing by $90 since we are paying cash for the shipping. And then what is the debit account? So we're going to classify this $90 in freight as part of the cost of inventory. So we're going to increase the cost of inventory by the $90. So we'll go ahead and input this inventory for 90. So that freight charge becomes part of the cost of inventory. So let's say you buy inventory that costs $5,000 and then you had to pay $100 in shipping. The $100 in shipping is just part of the cost of getting the inventory to you and getting it ready to be sold. So it's part of the cost of inventory. And then since I later have to keep track of this balance for inventory, we will increase this also by $90 here for the shipping for the merchandise inventory with a debit on the left side. So how much has inventory cost us so far? Well, it is the $20,250 purchase price plus the $90 in freight. So that is $20,340 so far. Let's go ahead and check our answer. Good job. Okay, so then now on February 9th, 7 days after our purchase, Tacoma Drugstore, that's us, we returned 5,000 of the merchandise due to damage during shipment. All right, so what is happening to our inventory account when we return this $5,000 of merchandise inventory? Well, the inventory account is going to go down. So let me switch to our scratch paper here. So we're going to reduce by 5,000 for the merchandise inventory with a credit. And then because this is a credit, I'm going to go ahead and enter that in on the second line here as credits after debits. So that is going to be merchandise inventory with a credit of 5,000. And then what will our debit account be? Well, remember we purchased this inventory on account, this accounts payable. So what's going to happen to our AP is it's going to go down by the same amount of the return. So I'm going to put a 5,000 here as well to reduce our accounts payable. And then it's going to go here, accounts payable with medical supplies for 5,000. So again, that accounts payable has been reduced by 5,000 because we returned this merchandise and we no longer owe the 5,000 for the inventory that is no longer with us here. So let's go ahead and check our answer. Excellent. Okay, now it is February 14th. So Tacoma Drugstore paid the amount due less the return and discount. So let's make sure we're getting that discount. So we bought the inventory on February 2nd, and now it is February 14th, so that is 12 days later. So that is within that 15-day period. So we will be getting that 3% discount. So let's first start by figuring out how much AP we owe. So remember, AP on our scratch paper here, you should have a purchase of $20,250, which increased our AP, and then we returned $5,000 worth of inventory. So then that would bring our AP down to $15,250. So that would be the balance then. So notice it says we paid the amount due. So what happens to this $15,250 balance is when we pay it off, how do we get rid of it? We have to debit it in order to get this balance to go away. So our AP is going down by this amount of $15,250. So we will input that as our debit, $15,250. So then if we owe this $15,250, but we're going to get a 3% discount according to the top of the problem up here, since we are paying within 15 days, we have to figure out the calculation of 15,250 times that 3% to see what our discount is. So we'll get our calculator out, which is down here at the bottom, and we'll go ahead and type in 15,250, and to turn that into 3%, we can multiply by 0.03 or by 3 in the percent key. So that is going to give us $457.50. However, this does want us to round to the nearest whole dollar. So we will go ahead and round this to 458. And you can see it says round to answers to the nearest whole dollar right here. So what we're going to want to do then is subtract 458 from the amount we owe to see how much cash we will be paying. So that is going to be $14,792. So that's going to decrease our asset, our cash, by that amount. So we are paying this amount. Now, if we take a look here at our transaction, it does not balance. So we have to be thinking about what our balancing account is. So in order to balance this transaction, we're going to need 458 as a credit. And then what account does that get credited to? Well, remember, if we take a look at our T accounts, when we pay inventory early and get a discount, it's going to lower the cost of inventory. It's not lowering the quantity of inventory, it's just lowering the costs. So up here where we have that $5,000 return, this is lowering both the cost and the quantity. So just for your information, in accounting systems, computerized accounting systems, the accounting system keeps track of the quantity behind the scenes. So we don't need to do a journal entry for that. So anyway, this $458 represents the cost of inventory going down. So that is why we are going to credit merchandise inventory here. So then let's go ahead and update our merchandise inventory balance here, less that discount. So that is going to give us a inventory cost of $14,882. So let's go ahead and check our answer in my accounting lab. Nice work. Okay. So now for requirement 2, in the final analysis, how much did the inventory cost Tacoma Drugstore? So since we have our handy dandy T account here, the balance left over in merchandise inventory is that $14,882. So that is going to be our answer. And as a side note, a lot of students get confused about this. So when we pay early, we get a discount on our purchase, and that discount amount lowers the cost of inventory. So here's how you technically calculate the cost of inventory. It's the net cost of inventory purchased equals the purchase cost of inventory, which is that $20,250 less purchase returns and allowances. So that was that $5,000, then less purchase discounts, which was that $458, and then we add freight in as a cost of $90, which gave us a balance then for the net cost of inventory purchased of $14,882. So that is it. We'll check our answer. And then if you really wanted to be a completist here and complete this exactly, you would post the $15,250 as a debit to the accounts payable to zero out accounts payable since we paid that off.